Due to the demand, there could potentially be more paper than there are bars standing behind it. That opens the door. People are wondering more or less if gold and silver have topped. Is that correct?
This bubble is ripe to pop. Overnight, prices were marked down very, very heavily. Now, I would suggest that there is some indigestion, if you like, in the Shanghai futures market, Shanghai Gold Futures Exchange.
I'm bullish on both. But it's because I'm so bullish on gold that I'm even more bullish on silver. Because I know eventually, if gold keeps going up, silver is going to catch up. Not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1.
Reduce reliance on the United States and of the dollar, and this is de-dollarization on a global scale. You're seeing just over the last couple of years, the Reserve Bank of India has doubled their gold reserves from 2.5 years ago. And you look at what China is doing. I mean, look, first of all, the amount of gold that China has is far more than they lead on to, as far as I'm concerned. And I mean, there's all sorts of evidence that points to that. They've opened up their insurance industry into buying gold, and albeit just a very small percentage. If they open it up even on a broader scale, the amount is extraordinary in terms of how much that they could actually bring in. We just talked about Poland and the amount of gold that they're bringing in, and now you have China that is at the same time allowing their banks to, or accelerating their accumulation through their banks by raising import quotas and allowing those banks to buy more U.S. dollars first to fund these purchases, which kind of, it's a dual move in the respect that first it meets the demand for more gold, the surging demand, but it also subtly reins in the yuan's appreciation against the dollar, which is something that I think Trump doesn't like, but that's a strategic move. And it's a hedge against not only the global volatility by accumulating all the gold, but also it signals ultimately a shift away from dollar dependence. So in the twist, they buy dollars to slowly depreciate the yuan and then use those dollars to buy gold and have upped and doubled the import quota. So they're slowly, they do things very methodically, not too fast to rattle the boat. They could have, everyone says, why not just buy it all at once? Because they would have cut off everything right there. Instead, they've been slowly and methodically on all different levels, from their insurance companies to here upping the quotas on the banks to state-sponsored accumulation programs through the Shanghai Metals Exchange. And now they're even going as far as trying to internationalize the yuan and gold settlement through the Shanghai Metals Exchange by opening other Shanghai hubs. First one is in Hong Kong. They're talking about doing one in Saudi Arabia and in other countries. Part of their renminbi cross-border payment system that we've talked about, where they will trade in local currencies across this hub, this bridge, which is the M-Bridge technology, the technology that settles in 7 seconds instead of 3 to 5 days through SWIFT, at a 98% reduction in cost, and then settle imbalances in gold. And that is ultimately what they're trying to do. The two pushbacks that people gave about the Brics is, one, they won't internationalize their yuan. This is what they are doing now. They're talking of opening up all of these hubs on behalf of the Shanghai Metals Exchange in these member countries in an effort to settle imbalances right then and there over the bridge network. And the second thing that is game-changing on all of this and needs to be said over and over and over again, and I have a habit of doing that, I've done that forever, but it's a narrative I want to drill it into people's head. The other pushback was that, well, it's just not a big enough block. Well, the fact that they are now opening up the bridge network to non-member countries like the Belt Road and the Shanghai Cooperation Organization and the Eurasian Economic Union and these ASEAN countries and the Middle East countries, you're talking potentially north of 90% of human population that will be able to trade outside of SWIFT over the bridge network, settle in 7 seconds with a 98% reduction in fees, no Western interference, and then settle imbalances in gold. That's where we're going. You can see this is the plan that they have, and doing it very subtly. But it's not just, not just China that's doing it. You're seeing all of these countries accumulate gold, all of them. And the countries they're associated with are very resource rich in all forms of commodities, many of them underdeveloped, but that's the whole point of the Belt Road. This whole thing is connected, and it's starting to accelerate. And maybe that's the realization that the Trump administration knows. And that's why they're hell-bent on accumulating commodities the way that they have been here in the country, and then also delivering them and not leaving them in paper so they can just float right back to England or Switzerland through exchange for physical or whatever the other vehicles that are available to the traders around the globe. Maybe that's why they're moving them into eligible, out of registered, or even taking them off the exchange so that they're no longer free game to be traded and sent backwards.
While the stock market was rallying, and gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500, and this morning it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks, and that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning, and it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price.
The liquidity has very much come from leasing, central bank, leasing of central bank gold. I mean, that was clear, and it was proved by the fact that bullion banks were queuing up to take gold out of the Bank of England vaults. I mean, these are banks which have accounts with the Bank of England. So it's possible for them to store some of their gold there, but they would tend not to. Therefore, at least a large amount of the gold that came out of the Bank of England was effectively leased gold. and it was taken by bullion banks who were benefiting, if you like, from the spread between futures, which were trading at a huge rate, interest rate premium. By interest rate, I mean compared with the gold lease rate. It was a simple interest rate arbitrage. Now, that is now stopped. And if you look at the COMEX warehouse gold stocks, they've now begun to decline. So that process